Investors, we've asked this question for almost a year now. Are we reliving the 1998 through 2000 dotcom Capex boom and internet and mobile internet build-out? Are we reliving that in the AI investment cycle, or is this something new and different? Investors, today, the AI boom feels a lot like it did to me back in the 1990s, and I had the opportunity to work in San Francisco and then manage money with Charles back in Houston during the dot-com run in stocks. Both cycles look and feel a bit similar with some twists. Investors, both periods of rapid Capex investment. Some tech and infrastructure stocks soared with big promises about the future. But underneath the surface, this cycle is not exactly the same. And these differences matter for you, your portfolio, and your retirement. Okay, so let's compare them. Today, we're going to compare one more time two very specific moments. The stall and re-acceleration phase of the dot-com cycle, which was the summer of 1999, second and third quarter, with the current trailing two quarters, the fourth quarter of 2025 and the first quarter of 2026, and the re-acceleration phase in AI today. As far as stocks go, think of both periods as the seventh inning stretch. Not the beginning of the cycle, but it's likely not the end either. It's the point where momentum is strong, many stocks and valuation paused, but some risk was starting to build. So let's compare the Capex. Back in 1999, companies were racing to build out the internet. Back then, it was fiber networks, it was telco infrastructure, and eventually the mobile internet. There were massive capacity being added, and it was ahead of real demand, ahead of the Amazons, ahead of Netflix and streaming services, and ahead of most mobile telephone applications that we're used today. That summer, mid-1999, was a seventh inning stretch, but the real excess in the equity markets came after that, into late first quarter 2000. In many ways, today it looks eerily similar to that period, but it's fundamentally different. AI spending is not early stage build out. We are 3 years into the launch of ChatGPT, which was November of 2022. Right now, it's an acceleration driven by real existing usage and demand for compute, for systems driven by Nvidia and other semiconductor chips. What's that shift now? It's called the agentic AI shift. Here's what's just changed that many investors don't yet see. Parabolic AI chat growth in 2025 through 2023, when it all started, has recently gone exponential in the first quarter of this year. Really, this has happened since OpenClaw app had its moment, and it's rebanding on January 29th, 2026. This was a tipping point beyond the vibe coding moment last year. AI is no longer just a tool, it's becoming agentic. So what does agentic mean? Agentic means this is systems that act on their own. They run queries, they make decisions, they give suggestions and execute tasks automatically, 24 hours a day, 7 days a week, every day of the year if you need it. This shift and that tipping point is driving explosive demand for computing power, rapid expansion of data centers, and most important, real revenue growth in applications at Anthropic, OpenAI, and Google's Gemini platforms. So investors, unlike 1999, this is not build it in hope. This is build it because it's already being used. Just ask Jensen Huang, founder of Nvidia. He spent the better part of half of Nvidia's recent GTC event on calling OpenClaw the most popular, the most successful open source project in the history of humanity. This is definitely the next ChatGPT, the CEO asserted. What is OpenClaw, investors? OpenClaw is an open source, autonomous AI agent platform that goes beyond traditional chatbots. Instead of answering questions, these agents can complete tasks, make decisions, and take actions with minimal input from humans and from users. Investors, that's a tipping point. So what's different this time? There's a difference between public and private markets this time. Now, this is one of the biggest differences I can see. Most investors are missing this. In 1999, capital flowed through public markets, through IPOs, which surged, speculation spread quickly, and retail investors carried much of the risk. Charles and I reminisce that we would spend most days in 3 to 5 IPO roadshows with companies and bankers. Fast forward to 2026, the most important AI companies are still private. OpenAI, Anthropic, ByteDance in China. Their funding comes from large institutions, strategic partners, and other big tech platforms, not from retail investors, Morgan Stanley, or Goldman Sachs. So investors, the structure is different. Back in 1999, a long time ago, when I was early in my career, the risk was largely public. Today, much of the risk is still privately held. That doesn't remove risk, but it does change where it sits. Investors, let's go look at the economic backdrop. Let's go back to the broader economy then. 1999 economic growth was strong. The Federal Reserve was tightening interest rates, but it was also creating special liquidity anticipation of the potential Y2K disruptions in 1999 and 2000. Investors said growth is steady, and it was about to accelerate in the second through fourth quarter. Inflation was about to peak around 3.5% and come down, and the Fed is on hold, but should be leaning to ease with the new Fed chair by mid-year. So as far as financial markets are concerned, they do look familiar, 1999 through 1996. In both periods, leadership was concentrated in technology companies and sectors driving big index returns, but back then, energy stocks did okay as well. But here's a key distinction. In 1999, many companies had no earnings. They traded on multiples of revenue. They traded on multiples of clicks, web page views, or as it's known today, or back then, eyeballs. And investors, if they did have earnings, they traded at 50 to 100 times earnings. See the valuation of Cisco back in the day and compare it to Nvidia nowadays. Many valuations back then were based on hope. Today, market leaders are highly profitable, generating real cash flow and seeing real earnings acceleration with AI demand. Yes, I have to admit, many are now free cash flow negative given their huge Capex spends and moving from asset light to more asset heavy. That is a major change today. So the risk today is not no earnings. The risk is paying too much for very good current earnings and uncertain future earnings and uncertain marginal return on invested capital. Okay, so let's go ahead and look at interest rates. Interest rates often decide how these cycles end. In 1999, rates were rising and liquidity was tightening. This pressure and too much speculation eventually broke the market. Today, investors' rates are also rising, but it's on inflation concerns. Hopefully, liquidity improves because financial conditions have tightened in March on the back of the war in Iran. A new Fed chair can help extend the cycle, but it doesn't eliminate risk. So right now, where are we? It looks like the seventh inning analogy holds true. A little history lesson and return to our much shared S&P 500 overlay. Here's the updated chart. Remember, no guarantees. Investors, think back to 1999. Mid-year was the seventh inning stretch. Market stalled for about 6 months after a V-bottom rally, following the strong 7-month rally post long-term capital management recovery in October 1998. After the third quarter 99, the market kept rising before peaking in very late first quarter 2000. Fast forward to today, late fourth quarter 2025, early first quarter 2026 also looks and feels like the seventh inning, which could tell you two things. There is still likely upside in stock markets, but the risk is increasing to the economy, particularly with the recent Iran oil, energy, and supply chain shocks, and potential risks to stocks and earnings might be beginning to build beneath the surface. One of the leading groups back then, the growth of the cyclical semi-equipment industry. Once again, here's that overlay updated. We shared this with you before. It looks like the seventh inning stretch right before orders for AI inference accelerate in the first through fourth quarters of this year. So investors, with that, what are the main takeaways? First, this is not 1999, although it is rhyming a lot. The foundation of the AI Capex cycle, profits and existing demand is much stronger today, and valuations are much lower. Second, while we are not early in an economic expansion due to agentic tipping point, we are likely entering the reacceleration phase, which should be good for many stocks. Third and finally, the structure of risk is different now. In 1999, it was in public markets and widespread. Today, much of it remains in the private markets and is concentrated. Investors, we know history doesn't exactly repeat, but given humans repeat many past behaviors and studying behavioral finance, it often rhymes. Right now, we're still seeing echoes of 1999 with a stronger foundation underneath and just exiting the seventh inning stretch. Investors, stay disciplined, stay diversified, and focus on what's real, not what's just exciting. Whether your priority is growth, income, or a combination of both, our team is here to help you plan for your family's financial future, no matter where you're at in your career or in your retirement journey. Have a great Easter weekend.